Okay, we're recording. Please go ahead.
Good afternoon, everyone. Today is the October 28th meeting of the Finance Committee, and seeing that we have a quorum, I'm calling the meeting to order. And to make sure we can hear and all committee members can hear us, because we're doing this virtually, I will call on everyone just to make sure communication is working. I'm Kathy Shane, I'm the chair. Bob Hegner,
Present.
Counselor Haneke,
Present.
Andy Steinberg,
Present.
Joe Jane,
Present.
and that's the committee. Today's agenda has four main items on it. The first, we usually take public comments at the beginning. And Sean, we've got the auditors coming, so
they're here in the audience.
So I know you also said they were strapped for time, that they have a hard stop, or one of them has a hard stop.
Yep. Yeah, if they could go near the beginning, that would make sure we have time for questions and things like that.
Okay. Let me see. We have 6 people in the audience. So I might, because they have a hard stop, is it all right with everyone if I shift the public comments to the back of the meeting, or just after the auditor report? I'll put it before the next. The other item, if Sean is ready, we were going to get an update on the school debt exclusion impact on taxes when we'll see it, and an update on the cash flow debt financing of Jones and how we're going to see that in the capital report. Those were the 2 big items, and then just the more general discussion of looking forward is on today's agenda. So I think we brought in audit. I see, Sean, I'm going to turn it over to you so you can introduce.
Okay, and there's one, Nadzia, do you want us to bring in Scott as well?
Yeah, Scott is here. Can you invite him?
Yeah, the S. McIntyre and the attendees. Let's see, I can promote him. Okay.
Mm-hmm.
All right, so I'll do a quick introduction. So our auditors, CBiz, formerly Markham, formerly Melanson and Heath, are here to go over the FY24 audit report. So we're, it's a little bit later than we typically do it, but we're going to start catching up. So this is actually dated June 30th, 2024. So you're going to have to kind of think back when we look at this. But so it wouldn't be last fiscal year, it'd be the year ending the prior fiscal year. But I'm going to turn it over to, I think, Scott to open it up.
Yes, thank you, Sean.
Yep.
Good afternoon, everyone. Pleased to be here to give you a walkthrough of our audit of your financial statements. I'll tell you a little bit about how the audit went. I'll also walk through some of the highlights of your financial statements and then our single audit report. Before I joined, I was able to hear some of the meeting. I appreciate, I do have a hard stop, but it's like at 3:15, maybe maximum 3:20. I can talk for financial statements for hours, but I hopefully that's going to give us enough time. I had to have rotator cuff surgery a couple of weeks ago, and I have a follow-up today at shortly after 3:30. So that's why I have the hard break. If we walk through this, there's still some questions or areas you want me to address further, I can reconvene at another time, or maybe the questions can all go through Sean and I can provide the committee answers. I appreciate you being able to accommodate me today to have this conversation and still make my appointment. Sean, I'm going to say a few more words, but will I have the ability to share my screen?
Yeah, we can do that.
Okay, thank you. In just a minute, I'm going to share my screen. I think it's important to walk through some of the documents that are the finished product. And I think if I'm sharing my screen, as opposed to referencing page numbers, that sometimes you may not know if it's a print page or a PDF page, it can be a little more convenient this way. When I first share my screen, I'm going to share what we call our governance letter. And that's a term that we in the audit profession use. And it's because it's the communication that our professional standards require us to report to This is a phrase that's in the professional standards, those charged with governance. And rather than call it that letter, the audit profession and just in general calls it the governance letter. But these are the things that our professional standards require us to communicate with you. Things like you've heard me talk about in the past, how the audit went, were there any significant audit adjustments, what the key estimates are, any disagreements and how to apply generally accepted accounting principles. All that stuff is included in what we refer to as your governance letter. And I'm going to quickly share my screen. And I just talked about a lot of these, so I'm not going to spend a lot of time on this letter. I'm going to in just a few minutes, I'll hop into the financial statements and the single audit report. But this audit will go finalized over the next couple of days. But this governance letter tells you, our planned scope and timing, that we obtained evidence on a test basis. It tells you the professional auditing standards that we utilized in order to conclude on our opinions that your financial statements are materially fairly presented in accordance with GAAP or generally accepted accounting principles. We do need to tell you that we did identify management override of internal controls as a significant risk. I will tell you that in every audit, CBIZ, Markham, Melanson Heath, and every other firm in the country identifies this as a risk. And that's because our professional standards require us to identify it as a significant risk. So what does that mean? It means we must design specific tests in order to make sure that we have evaluated your risk of management overriding your internal control structure to make sure that there are no significant, material errors in your financial statements. And we have done that. We have concluded, based on the test work we have done, the specific test work that we have done, we have come to the conclusion that management did not override the internal control system that in any way that would have resulted in a material adjustment to your financial statements. Some of the qualitative aspects that Amherst employs, this is where we talk about estimates. The collectability of estimates is certainly one. The estimated useful lives of your capital assets and depreciation are certainly estimates, as well as your net OPEB liability and your net pension liability and the related accounts that go along with those, the deferred outflows of resources, etc. We think the disclosures regarding those significant estimates are appropriate under the circumstances. This is one I certainly like to talk about when it applies, and it almost always does. It certainly does in Amherst. We encountered no significant difficulties in dealing with management and the performance of our audit. Independence, we are independent from the town. Our professional standards require us to not only tell you, remind you of this, but also tell you that we did participate in what we call a non-attest or service, which is the preparation of your financial statements. Technically, that's what we call a non-attest service, not audit related. We do it for Amherst like we do for every other community we audit in the Commonwealth of Massachusetts. We audit your books and records, and from your books and records, we help you prepare, this 80, 90 page document. It's an additional service that we do. Uncorrected misstatements, we did not need to propose any significant audit entries as a result of our work. Disagreements with management, sometimes there are some. There were no significant disagreements with management on how to apply generally accepted accounting principles during the year. So some other things in here, we did not note any significant or unusual transactions in your fiscal year 2004. So this governance letter is what I would call a clean letter. It's when there's no communication in here that says we had a really hard time auditing your cash or anything like that. This is the way I think audit committees and those charged with governance, this is what they would call a clean governance letter. There's nothing to highlight in here. And as I've said a few times over my career, is most places want a relatively boring report from their auditors. If you're getting a real juicy report, it's probably not a good thing. So, but enough of that. That's the governance letter. Now, if I'm going to hop over to your financial statements, and I just since I just closed that document, I could maybe the chair or Sean, could you let me know that you're still seeing on my screen, your basic
Yeah,
financial
we're
statements?
still seeing your screen, and to the extent a committee member has a question or a comment, they will raise their hand, Sean.
Thank you. And if you, as
And
the chair, could
I'll
just,
stop you if I see a hand go up.
thank you. Well, the first page everyone turns to in the audit report is the independent auditor's report. There's nothing really to highlight here because it's nothing different than prior years. Same opinion as you've had for the last many years. Don't know exactly how long, but in our opinion, based on the audit work that we did, and I'll also highlight for you, we're referencing the professional standards that we followed, generally accepted government auditing standards, as well as generally accepted auditing standards. We followed both sets of standards as required. And in our opinion, your financial statements are materially fairly presented in accordance with generally accepted accounting principles here in the United States of America. Fancy way of saying what most people refer to as a clean audit opinion. There are no modifications. We're not saying that anything deviates from the norm here. In our opinion, based on our test work, your financial statements are materially fairly presented in accordance with GAAP, or generally accepted accounting principles. Now, following your MD&A, following our independent auditor's report is your management's discussion and analysis. Also, and I will probably likely today refer to it as MD&A, which is just kind of a common way to refer to it. It's a great resource to go back to at a later point in time to understand why certain key account balances may have changed. I'm actually going to go directly to your basic financial statements because there's some account balances in there that are just worthy of discussion. And then I think many of the things we'll talk about as we go through the document, you can go back to in your MD&A at a later point in time and see the things that we've talked about this afternoon. So I'm starting here on your statement of net position. Starts on print page 40, and it goes 14, excuse me, and it goes on to print page 15. If there are, I feel confident I would have said this in prior meetings with Amherst, but if there are some new committee members, there are essentially two sets of financial statements in the document we've prepared for you, just like the document we prepare for every government, both in the Commonwealth of Massachusetts and elsewhere. I generally refer to the page you're looking at right now as the long-term perspective balance sheet. Long-term perspective because it includes things like your capital assets, your investment in land and buildings and improvements and things like that. And as I scroll down into page 15, you see the other side of the balance sheet, the liabilities and net position. In the governmental world, it's not called equity, it's called net position. And you see long-term liabilities in here, your net pension liability and your net OPEB liability. Again, this is the long-term perspective balance sheet. Technically, it's called a statement of net position. In a minute, we'll look at your general fund balance sheet, which is really thought of as your short-term perspective balance sheet. Now, really the only thing I want to point out, because we think it's part of our no conversation about a local government's financial statements nowadays would be complete without at least talking about your net pension liability and your net OPEB liability. The net pension liability, that is your proportional share of Hampshire County's overall pension liability. For your governmental funds, that's this first column of numbers. The middle column of numbers are your enterprise funds. So for your governmental funds, it's almost $43 million. In total, it's about $47.6 million. Now, a couple of things to point out there is, the biggest driving assumption when it comes to yours or anyone else's net pension liability is the discount rate. Discount rate, if you're not familiar, that's the estimated future earnings of the available pension plan assets. In Hampshire County and town of Amherst is using a discount rate of about 6.88%. That's consistent over the prior year. I know PERAC likes to see things. I've heard them say 6.75%. I've heard them say 7. You're just a hair above that 6.75. no, our firm does not take issue with a discount rate of 6.8%. Those that are well in excess of 7%, the auditors are having a different type of conversation with management and communities and county systems that are using something well in excess of 7%. Now, the other I said there were two key things about your pension liability, the discount rate being one of them, and that is the accounting side of the equation. The funding side of things is very different, and I'm not going to get into the overall difference unless there are specific questions. But you pay your assessment into the Hampshire County Retirement System to pay down this liability. It's always important to remember, because obviously the 42 million is a significant account balance, but it's important to remember that you're on a funding schedule. Pardon me, the county retirement system is on a funding schedule. And the latest one that was approved by PERAC, the state oversight agency, has your system being fully funded in 2032, which it's 7 years away. I think that's important for context because yes, the liability is a big number. But if the funding schedule is set to mature in 7 years, obviously assumptions need to materialize. But if the assumptions continue to materialize and you keep doing what you're doing for the next 7 years and the system doesn't extend its timeline, then you're going to bring that liability down to zero. Next up is the net OPEB liability. OPEB being the other post-employment benefits, fancy way of saying for retiree health care. It's called a net liability because Amherst does have a OPEB trust fund. It's a separate page in financial statements. We'll glance at it later on. I'm seeing, Madam Chair, I'm seeing somebody has a hand up. I don't know if you want to.
Sean.
Sorry, it's me. Sorry to interject.
Yep.
Just on the retirement system, just so everyone knows, we do have a representative from Amherst who sits on the as a trustee or on the board of the retirement system, Jen LaFountain, our treasurer. And I think an important point is the full funding in 2032. So now all systems are on track to be fully funded that early. That's a good thing that we're, this liability looks big, but we're paying down a big portion of it every year. So I think technically it could be fully funded up until 2040, but we're way, towards the earlier end of that spectrum. So while it's a big number, it's actually a good thing that we're getting pretty close to fully funding. And then there's going to be sort of these different conversations we're going to have with the retirement system and throughout the town, because once it's fully funded, our retirement assessment is going to go down, and how it goes down is the discussion we have to have with the retirement system. But so big number, but we're actually in a really strong position with getting it fully funded.
Thank you. And that added comment about the assessment going down is actually, I'm glad you brought that up, Sean, because it really leads into a point when we talk about the net OPEB liability that I think is just important for readers and users of your financial statements to understand. And in the end, I'm going to suggest a added sentence or two be brought into your footnotes regarding your net OPEB liability. OPEB, as I was saying, stands for other post-employment benefits. Fancy way of saying this deals with retiree health care. You have an actuarial evaluation done in every other year, and you do a report every year to put this liability in your financial statements. Key things with this estimated liability deal with the fact that you have a trust. Trust is about 18% funded as of 6/30/24. That's reasonably well funded. I have some clients that are 80-85%. A number of them are around 15-20% where Amherst is. Some are around 1%, and some don't have a trust. So that's good news. Good news for Amherst. Now, the key thing that goes into you using it. Sorry, I don't think I told you that you're using a discount rate for your OPEB liability of 6.97%. For simplification, I'm just going to call that 7% because it's just a slight tick but below 7%. Technically, it's 6.9%, but a 7% discount rate. One of the things that's embedded in the accounting standards is you can use a discount rate of that if the trust were to pay benefits and it to never go into a negative situation. And yours, given the current funding schedule, is not expected to do that. But one of the things that's in your OPEB valuation is sort of a timeline of the contributions that go into your OPEB trust fund. And this is where it ties in with the maturing of the pension liability in 7 years, is that one of the key assumptions is that in 7 years, when, as Sean indicated, the assessment from Hampshire County, it doesn't go to zero because you have the normal cost. What will go down significantly is funding of the past service cost. And one of your assumptions is the town of Amherst taking some or all of those dollars that have previously every year gone to the retirement liability and putting it towards the OPEB trust fund to eventually fully fund the OPEB liability. Now, I'm not saying there's anything wrong with that assumption, but it's assumption that I'm bringing it up here today because I want to make sure everybody in Amherst is aware of it, because it's an important assumption, because if you don't have that assumption, there's a good chance that you use a discount rate less than 6.97%. So it's an important assumption. It's one that's you're not the only client that CBIZ has that has a similar assumption. In fact, there are several clients that do it. Our job is to point out areas that, in addition to auditing your financial statements, we view our job as pointing out things that we want to make sure you're fully aware of. And knowing that we want those charged with governance to be fully aware of this assumption. Can assumptions change over time? Absolutely. Absolutely. That's where those deferred inflows and deferred outflows of resources comes from. When you change assumptions, the impact of those get deferred and amortized over approximately 5 years.
Sean, if we could just stop for a second, because I see Councillor Haneke, she has a comment or question on what you've just told us about OPEB, I think. Correct, Mandy?
Yes, it's more of a verbal comment to the public listening. If they were to look at our financial indicators statements or the budget, where we're putting approximately 8.5 million this year to retirement assessments. And what you just said, Scott, is that, at some point in 7 years, which I know is not next year, right? But as people hear, oh, it's going to be fully funded, and they'll look at that 8.5 million and say, oh, we'll have that for operations, say. What you just said and what the assumption going on for the finance committee at this point and the finance director and all is that some of that 8.5 million will stay in that line for retirement assessment. But the other part would not be open for operations because it will be transferred down to the OPEB line below. Just for the public listening. It's not like we'll suddenly have 8.5 million to add to our operations, given the assumptions we're making.
So Mandy, I just want to include a question at the end. Does it mean that all of it, so that 8 million goes from one line to another line, and maybe Sean can be, or are we saying a big chunk of it will still be needed for OPED?
Is it okay if I answer that, Kathy?
Yeah.
So it's not all of it. It's, it's maybe a few $1,000,000, but we can look at that on its own at some point. When we get the funding schedules from Hampshire County, they give us a breakdown of sort of what's the normal cost that we have to make every year, just as for employees that are working now. And as Scott said, how much is sort of making up past liabilities. And it's that making up past liabilities piece that we would no longer have to pay to the retirement system. As Scott said, there's a lot of assumptions over the next 7 years. If there's a market decline, that would impact it. If something happens where people live longer or anything like that, like there's a lot of assumptions. Just like we have an actuarial analysis for OPEB, they have that same analysis for the retirement system, and sometimes we actually use the same actuary. But theoretically, some of that could at some point free up in the 2030s. And we, a couple of years ago, actually did an analysis. We worked with our actuary to model what would it look like if we shifted all of the savings towards OPEB. What would it look like if we shifted half of the savings to OPEB? So we ran some different options. And I can't remember if we reviewed that with the finance committee back then or not, but we could dust that off at some point and look at that. And it kind of shows like how many years would it take us to fully fund OPEB based on how much we shift towards OPEB. But again, the good news is we're setting aside a little bit towards OPEB every year, not anywhere near where we need to be in order to fund it anytime soon. But we do have this possible funding on the horizon that could be shifted to help us fully fund that as well.
Thank you.
Thanks.
As you may be able to tell, I could probably talk about pension and OPEB for hours, but I usually touch on the surface about them and take questions. I'd like to move onto what we would refer to as the second set of financial statements in here. This is your balance sheet for your governmental funds. If the opinion is the first place, the auditor's opinion is the first place that most readers turn to, this is the second page. They don't look at the MD&A, and most don't even look at pension and OPEB. They come right to your governmental funds balance sheet, and they look in the first column of numbers, your general fund, and they look down here in the bottom third, and more specifically, the third number up from the bottom, your unassigned fund balance with a June 30, 2024 balance of $23.6 million. That's really the first place that almost all readers are going to turn. It's important for me to remind that the committee and anyone else that might be listening, there's really two components to your $23.6 million. Amherst, like every other community in the Commonwealth, has its general fund, and you also have a stabilization fund. Amherst accounts for stabilization fund completely separate from the general fund, again, just like every other community in the state. However, for formal reporting purposes, they are essentially one and the same. So your $23.6 million is really made up of two things. Your unassigned fund balance in your actual general fund of 13.6 and your general stabilization. The word general in that comment is important. And your general stabilization as of the year end here was 9.9 million. So there's two components that make up that 23.6 million. Your unassigned fund balance in your general fund, which is the starting point for the DOR certifying your free cash, plus, in your case, almost $9.9 million in general stabilization. I say general because what we mean by that is there's no particular expenditure purpose associated with the money. It's set aside for future budget use and nothing in particular. Up here in your committed fund balance of $8.2 million, you have two specific stabilization accounts. I would have to go to the back. I believe it's a capital and a reparation stabilization fund. But because there is a specific expenditure purpose associated with that stabilization fund, it's committed. Those dollars are committed for that purpose. There's no expenditure purpose with your general stabilization, which is why it's shown as unassigned fund balance. Really quickly, other things on your governmental funds balance sheet. Once again, 6/30/24, you have a major fund for your ARPA. The cash and investments that you have is completely offset by this revenue. Pardon me, this unearned revenue, which is a liability. All that means is you've received, like everybody else, you received the ARPA money up front. When you spend it, then you have the ability to recognize the revenue. Accounting principles don't allow you to recognize it as revenue until you do with it what you said you were going to do with it, which is all those purposes that you can spend the money on. So when you spend it, there's an actual recognition of revenue and the expenditure. That's why fund balance or net or equity is zero, because anytime you spend it, you recognize the revenue. So it's always a net zero to the income statement, if you will. A couple of other major funds, your town's capital project fund and your borrowing funds, normal capital project activity for Amherst, as well as many other communities in the Commonwealth. You know what? I'm sorry, I meant to talk for another minute about your unassigned fund balance in the general fund. Collectively, those two pieces that make that up represent about 28% of your general fund expenditures. It's a strong balance sheet.
And
A
where do
year
we see
ago,
those two? Where do we see those two that make up that balance?
The two that make that up are your general stabilization account and your general fund unassigned fund balance. They make up the 23.6, and collectively that 23.6 is equal to about 28% of your general fund expenditures.
Okay, is that denoted in this report somewhere?
It is. It's in the
Okay.
MD&A.
Awesome, thank you
That's
so
why I
much.
said it's a great resource to go back to at a
Sure.
later point in time.
Thank you.
It's a strong balance sheet. It's a strong balance sheet. A year ago, this number here was 20.3 and represented, I'm sorry, I don't have the percentage on my notes. It is in your MD&A though.
Okay.
So you can go look at that. So jumping forward, I want to talk about your enterprise funds for a minute. I'm always careful how I say this. So it may seem like I'm being overly careful here, but I talk about this a lot with clients. You have I'm only going to really talk about the major enterprise funds, your sewer and water. And what I typically tell clients, and when I've done some public speaking in this, is I'm not telling you the balance sheet or technically it's called a statement of net position. I'm not telling you to ignore it. I'm not telling you to ignore it. Likewise, on your statement of revenues and expenditures, I'm not telling you to ignore that one either. But what I am telling you is jump right to the cash flow statement, because this has the information that most readers want to know. And when I say most readers, I'm referring to credit rating agencies and financial institutions. You go back to the balance sheet for a minute. You've got a net OPEB asset here. You got these deferred outflows of resources here. You've got bonds payable. You've got net pension liability. You got deferred outflows resources. Most readers don't understand all that stuff. I'm just being very blunt. I've been doing this a long time. What people understand is are the enterprise funds, are they generating enough cash for operations and to cover the principal and interest on your long-term debt? So again, I'm not saying the balance sheet's unimportant. I'm not saying the statement of revenues and expenditures is unimportant, but go to the statement of cash flows. It's where all the good stuff is, as I say. You want to look at this row right here. Net cash provided by operations. Okay. And you want to know that covers the principal on your long-term debt and the interest on your long-term debt. And if you look here in the sewer fund, the principal on your bonds, not your notes, but bonds, $453,000. The interest, and that includes interest on bonds and notes, but you collectively put those two cash disbursements for principal and interest out there. Your net cash provided by operations covers the principal and interest on your long-term debt. You're making enough, you're generating enough cash to cover operations. You're issuing debt you're issuing debt because you see proceeds of notes, proceeds of bonds, and you're putting $750,000 back into the investment of the infrastructure of the sewer plant and the water plant. Does the net cash provided by operations, does it cover principal and interest on long-term debt? That is, in my professional opinion, the best way to judge your enterprise funds. There's too many accounts on the balance sheet to make it, in my opinion, meaningful. I'm not saying don't go look at it, but this is where it comes back to basics, if you will. So,
And we're not considering here principal payments on notes?
no, we're not, because the principal notes, it gets paid and then it gets sold as a long-term debt. So if it's sold to one institution, it may be refinanced at another. So there can be some cash flow for that. But it's really the equivalent of it being rolled from a short-term note into a long-term note.
Okay, thank you.
And that's a really good question, because a long time ago, yours truly combined these two rows right here. And this is where I learned, because I had Moody's call me and say, what's going on here? Something doesn't make sense. And that was very educational for me. And I probably wouldn't articulate it this way to you unless Moody's had called and I had had a one-on-one conversation about this particular client. So it's a really good question. And it's why the credit goes to Nad Zayer. I may do the talking here, but Nad Zayer helped put this together. That is why she segregated them out, so the reader, Moody's, would see the distinction.
Thanks for pointing that out. I appreciate that.
Okay, I'm going to go over a couple more pages to Amherst's OPEB trust fund. I usually go to the statement of revenues and expenditures rather than the balance sheet, because it's what this tells you is you have $14 million in your trust fund that is restricted for OPEB benefits. Important to know. The other thing to point out is the contributions of $4.6 million and the expenditures, or the deductions, they're technically called, of $3.8 million. That $3.8 million is an estimate from your actuary. We agree with the estimate, but it's an estimate from your actuary that represents what is known as the implicit cost is. It's not an actual cash disbursement that you're making out of your trust fund, but it's the actual cost to having retirees, those that aren't working anymore, on your existing healthcare plan as they are permitted to do. I point that out so you have the proper, what I think you would have the proper context in comparing it to this number here. Amherst is not making a cash contribution of $4.6 million. You're making a cash contribution of the difference between these two numbers. About $800,000 is what you're doing for a cash contribution. But implicitly, you fund that implicit subsidy. So that's why these two numbers are as high as they are. But the net between them is what I think you should look at, and to know what you're contributing cash to this trust fund above and beyond the pay-as-you-go method. And the pay-as-you-go is the 3.8 as both an expenditure and as a revenue. That's just a wash. The difference is what you're actually doing in cash. So, other things in the report to note. I'm going to jump over the footnotes. There's a wealth of information in there, all the detailed assumptions that go on. But I want to take you to your general fund budget versus actual page right here. The focus on this, and quite honestly, a lot of people, after they look at the unassigned fund balance in your general fund, the next place they turn to is here. People like Nadzair and I appreciate it when people will look at the enterprise funds and look at the footnotes and what have you. But this note, there's no doubt, this is probably the second most viewed page in this report. What this tells you is that for fiscal year 2024, revenues came in $4.3 million greater than anticipated. We've seen that a lot in fiscal year 24, driven by a couple of things: continued strong motor vehicle excise collections and strong investment earnings compared to budget. On the expenditure side of the equation, again, the focus is on this last column of numbers, the positive, in your case, the positive variances, budget and actual. $2.1 million in unspent and unencumbered appropriations. A year ago, that was $3 million. Still $2 million on a budget of 86 million is a good turn back. And I think it shows both on the revenue side and the expenditure side, shows conservative budgeting practices. You know, I would note that a year ago, this number was 260,000. Now it's just under 60,000. And the big one was in the prior year, you had unspent and unencumbered debt service appropriation of about $1 million. So there probably was a timing issue that occurred in there in the prior year. Now, the last thing I want to point out on here, and this goes to making sure readers understand the financial statements. I want to point out some of the text over here. The use of free cash. Free cash, I'm sure the committee's aware, it's a Massachusetts thing. The Department of Revenue certifies your free cash, and then it's free to be appropriated by the appropriating body. Now, Zaire, again, has done a nice job here in outlining the purpose of which you used free cash for. And we think that's important because we think that's what most readers want to know. I feel like I'm telling the story of Moody's calling me. I had a client once when I prepared the financial statements, I said they used free cash of $5 million. Well, it gave the reader the impression that they used it for operations. And in their case, they used it for capital and OPEB purposes, which is kind of like Amherst. If you look at the $4.5 million, the combined $4.5 million that you've used, you put 3.3 million into stabilization. You transferred $200,000 to a special revenue fund. I forget what that is, but it's not particularly important. And then you put $1 million into your capital budget. What you don't see here is the use of free cash for operating purposes. I think those are wise decisions that are being made. Because if you use it for operations one year, you got to make sure it's regenerated. And here, you're putting the vast majority of your your appropriation of certified free cash is going into a stabilization fund. Real smart use of reserves and not using them for, not using one-time revenues, if you will, for recurring operating expenditures. So now, lastly, I want to point out another report over here is what we refer to as our single audit report. There are essentially two reports in here, as outlined in the table of contents here. One is required by government auditing standards. It's our report on internal controls. And we say government and auditing standards. Remember when we looked at our opinion on the financial statements, I said we're two sets of auditing standards that we followed. One is government auditing standards. This set of audit standards requires us to give you a formal report that essentially outlines if our work disclosed any significant deficiencies or material weaknesses in your internal control structure. We're going to look at the report, but the good news is, based on our audit and the standards that we followed, we did not identify any significant deficiencies or material weaknesses. The second report that we are required to issue to you folks is in accordance with uniform guidance. That's a fancy way of saying, as a recipient of federal money and spending of federal money, the feds have an audit programs that we need to follow to make sure your internal control structure is sound over your administration of federal grants, and what you spent that money on is consistent with the purposes of which that grant is made. So as we dive into some of the detail here, the first report again is based on government and auditing standards. I'm going to skip real quickly over this stuff, but it gives you the definition of things like a material weakness and significant deficiency. Let's just say we'd be having a longer conversation if there were significant deficiencies or material weaknesses. But you can tell in here, we did not find, and I'm not reading it exactly, but it says we did not identify any significant deficiencies or material weaknesses. Again, the uniform guidance report, same type of thing here. If we found deficiencies in your administration of federal grants, they would be included in here, as well as what that finding was. I'll go to what I call, well, I'm going to skip over your CFA, or Schedule of Expenditures of Federal Awards. There's a summary page associated with this document. And quite honestly, I think the feds like to see it all on one piece of paper here. That's my own opinion. Our opinion in your financial statements is unmodified, clean opinion. Did we identify any significant deficiencies and material weaknesses? No, we did not. Any issues of non-compliance? No. Federal awards? Any material weaknesses, significant deficiencies? No. Any other findings? No. And it tells you the two programs, and it's not always two. We have to get a certain amount of coverage. We go through a risk assessment and we evaluate which federal programs need to be tested in accordance with a matrix that's put out by the federal government. And for fiscal year 2024, we were required to test, or we selected the fiscal recovery funds, the ARPA money. For most of our clients, that was selected in fiscal year 24, as you can well imagine, in the drinking water state revolving loan. That again is a very common program that we test. Those are the two programs we tested. I want you to know that this report exists. It's referenced in our financial statement opinion, so it's important to see both together. It's part of the package, if you will. And that Zayo later this week, once this all gets finalized and what have you, we'll upload these reports to what is known as the Federal Audit Clearinghouse, so that the feds can then review our work and know that Amherst complied in all material respects with a sound internal control structure in general and over the administration of federal grants. So With that, that is believe it or not, I count that as a fairly quick walkthrough of the financial statements. There's so much going on in there. I probably went maybe longer than some committee members had hoped. I apologize for that. There's so much in there that I just think is worth talking about. So I hope I didn't go too long, folks. But I will try to answer any other questions that you may have.
Thank you, Sean, and I'll open it for questions or comments, and I'm gonna wait for hands to go up because I have a few. Bob, go ahead.
You should also just note that Tom has joined us.
Oh, thank you. Yeah, Tom, so just let us make sure we can hear you. Yeah,
I can hear
Say-
you. I hope you can hear me.
So-
you are loud and clear. Thanks.
So my biggest concern is the future of OPEB when we've seen a lot of inflation in health insurance and in, prescription drug coverage. I mean, my wife and I are looking at right now at Social Security, and it's going to hit us as well. So what if those blow up, so to speak, if they get out of control, what's the impact on our being able to sort of pay off the OPEB liabilities, over time?
I can answer that. I'm going to very quickly show you something that's deep in the disclosures here. So I'll share my screen in a second. I'm just getting to the page that will help me answer your question. And when I get there, what I'm going to share is what is known as a sensitivity analysis. I think I'm back sharing a screen.
Yep,
Yes.
you
Okay.
are.
This is the sensitivity. There's two parts to this. This is your OPEB liability, $64.5 million. Now, I'm going to address your question in a minute, but because I spoke earlier about the fact that you're using a 6.97% rate, and that is driven at least in part because of the future in 2032, you're going to transfer some retirement funding in here. This tells you that if you had a 5.97% rate, you wouldn't have a $64 million liability. You'd have almost $75 million liability. Okay. Now to address your question, the healthcare trend rate that the actuary used is consistent with most clients is 6%. This sensitivity analysis tells you that if it jumped up to 7%, it would go to $76 million. And just as importantly, your actuarially determined contribution to go into the fund to keep it being scheduled to be fully funded would have to increase. Okay.
Thank you.
But tell me I hope I answered your question.
You did answer my question. Thank you.
But Bob, I just want to, maybe Sean's going to say this already. I was going to ask about OPEB. OPEB, unlike our health insurance, for the non-retirees, OPEB is paying, and Sean should correct me, both Seans, but it's paying a copayment on Medicare. It's paying a premium and it's paying drugs. So it's not seeing all of hospital, all of doctor, because otherwise 6% is way lower than anything we're seeing on trends in health insurance. So am I right? Is that why?
Kathy,
is
can I
that-
say two things?
Yeah. So that
One,
was my question of what's
Yeah.
such a big difference? Yeah.
I just want to clarify, it's Scott from
Scott, no,
CBIZ, yeah.
Scott, right.
Just so,
Scott.
two Sean's is too many,
Oh,
right?
no,
So
it's
it's,
Scott.
and the other thing to remember, so that trend, that's over, I don't know, Scott, if you remember, but that's over like 30 years. So, you're looking at this year, and obviously we've all seen double-digit health insurance increases, but when they look at that, they forecast, it might be more than 30 years into the future, and factor in what they think healthcare cost inflation will look like. And so Kathy, I'm not, I think we'll have a separate presentation with the actuary on OPEB at some point in the future. And we can dig into like what components, and Scott may have more insight into this, but like what are the specific components, but I think it does look at sort of all medical costs and what they anticipate it'll rise over the long term. So even the 6% is, I feel like, higher than it has historically been. And I think that probably reflects that healthcare costs have been going up. I remember, I want to say 5-6 years ago, it was in the 4 or 5% range when I used to look at those. So the fact that it's 6% long term, it is pretty high already. But I know it feels like it could go higher based on what we've seen.
And I know at one point when people were looking at current, if we stayed at current, it would be 100% of GDP. So people think we can't quite get there, in terms of, that, so there's this assumption that something will happen out there when you go super long term. Is what I think you're saying, Sean, yeah.
Yeah, no, I've heard that from actuaries too, that they, when they look out, like it can't possibly increase at 10% every year for the next 30 years, or no one will have any money left, right? So there will have to be some costs controls put in place to control that.
So I had a separate question on the other. You noted when you went through on our revenue side, and you're looking at FY 24, and you're soon, or you started to look at 25. Is it, I think you said it's been common in other municipalities that excise revenues and interest revenues were higher than forecast. Is everyone seeing that? And is there a reason why that's happening, over, because ours have been distinctly higher. And I just want to know how much of it's a shared experience. Is that a recovery from COVID, that people are buying new cars and excise taxes came in higher and we were conservative? So it's an observation as you look across different towns.
It's just that it's an observation. I mentioned that I think Amherst historically is budgeted conservatively. I'm very happy to be able to say that the vast majority of our clients actually budget conservatively. So that too contributes to the favorable, excise revenues. I do think new auto sales have remained very strong over the past couple of years, which has led to that. And interest rates have certainly been substantially better than, 22, something like that.
Oh, I see both Mandy and Sean.
I was just going to quickly say, related to that, as cars get more expensive, we'll also see excise, right? Because it's based on so many thousands per value, and we've seen car prices get more expensive since COVID. And I hear the average, I think I just read the average car value is like over $30,000 now, which is a new, higher than it's been historically. So that's another thing that we'll have to adjust our budgeting as we look at how we budget motor vehicle excise tax in particular. Is if we see that trend going higher and it's tied to the value of vehicles, we'll make the adjustments.
But that was my question, Sean, that you can see what's happening underneath it. So we conservative versus just wrong, when you could have known, you could have made an adjustment. Oh,
Yep.
Mandy.
Yeah, that leads into sort of my question. Welcome back, Sean. I haven't spoken much, but I don't know how much you heard about last budget season. Kathy and I and the Finance Committee really pushed for a little bit less conservative, but still conservative revenue forecasting. And so, Scott, as you were going through this budget and actual, and I know this is like almost a year plus ago. So this is not the one we haven't seen, the one that ended June of this year. But we have struggled with what is a logical sort of, 4 million above a 4 million variance on $88 million revenue estimates and a $2 million variance on an $86 million expenditure estimate. And you said that's sort of well within the expectations. As an auditor, what sort of are the expectations you're looking for in sort of those variances for responsible budgeting practices? And I don't know if I'm wording this question right. So if we had an expected revenue of $100 million you saw a variance of, you know, $100,000, what would your
Yeah.
comment be? You know, like where
Yeah.
where would you be comfortable with on those variances on both ends, on the revenue side and the expenditure side?
Well, this will probably sound like a canned answer. And it's just probably me being cautious, meaning we've been asked to audit the basic financial statements, and we've done that. And I probably would get myself into trouble if I said it's 100 grand here, 100 grand there. Those things, I've been around for almost 40 years. They come back to bite me when I quantify things like that. What I do typically point out is if there's a negative, and I won't take them if we need to, I can share my screen again. But if there's a negative in the variance column on the revenue side, what I look at is I don't really look at the actual, my eyes don't go to the actual first. It goes to how much did the budget go up over the prior year? Because a lot of times revenues are pretty consistent. And if there's all of a sudden a year in which something's negative, is it because the budget went up by a substantial amount? So I share that. Look, I know I'm not specifically answering your question. It's just not something auditors should dive into. But I'm trying to share some element of what an auditor looks at, who's been doing this a long time. It's not all about the actual to actual. Sometimes you got to go look at the budget to budget. Those are where negative variances usually originate from.
Thank you.
Other questions or comments? So I noted, I just have a general one, Sean. I noted this is marked draft. It's actually a draft that seems to have been on a desk somewhere for a while, you know, in terms of when it was
No,
finished.
it has to be dated June. So the report has to be dated the end of the fiscal year. So the June
Okay.
30th, 2024 is just the end of FY24.
Yeah, there's just this red stamp up in the corner that keeps saying, you know, it was finished in October 2024, you know, way
I
up.
think it's 25, or maybe I'm
25.
looking.
Yeah.
Yeah.
10/21/25.
Okay, so my question is, if, I don't think I saw any, but are we recommending approval, acceptance of the draft? Is this final? And, you know, are you still looking for, are there small typos somewhere, not in the tables, but in the
Yeah,
text?
we've sent a few little questions, nothing super material. One thing I have to get Scott is just subsequent events, which we have done some borrowing in FY25. They, you know, I'm sure CBIZ to an extent is aware of some of the borrowing we've done, but I want to make sure that they have the, you know, the additional borrowings we've done for like Fort River, for example. So there's a little bit there, but other than that, I don't suspect it'll change these numbers much, but there might be some additional disclosures related to that.
If I may, we do want to add a sentence, maybe it's 2 sentences in the notes, the OPEB actuarial assumptions. I just want to make the statement that a key funding assumption is that in 2032, you'll start putting X number of dollars in annually. And that's all already spelled out in your OPEB valuation. So I will use the numbers that are in there.
Andy?
Yeah, it was more of a comment than a question. There was something that you said, Scott, that I picked up on and have been thinking about since you said it. And that is that when you were talking about free cash and that you were looking not just at how what free cash was, but how it was used, and that you don't look as a solid planning mechanism using it for operations. And I just want to note for anyone who's listening to this meeting otherwise that there's been a lot of concern in this community and in other communities too, other municipalities, about cost increases that have come about in operations that have been greater than revenue increases over the past year or two in particular, more than I've seen in quite a while. And it has created this conversation that is going on in the community about using free cash more for operations. So the comment that you made, I think, is something that we all need to remember after this meeting. So that was my comment.
Thank you, Andy. So Sean, I just need guidance on, are we recommending acceptance of this? What action do we need to take today in the Finance Committee?
Yeah, Paul, I don't know if you're here. I don't know if you have to vote to accept. You could if you want. I think this is, we wanted to make sure we shared the report with you and get any of your questions answered. I can't recall if we historically have voted to accept it or not. But if you want to, you can. If you want to wait till it's final, completely final, I can bring it back at a future meeting as well. Scott would probably not be there at that point, but you could, you'd be voting on the final version.
I mean, you could acknowledge receipt of it. Acceptance means that you agree with everything in it. And I'm not sure if that's what the council has done in the past.
Right. Thank you.
Kathy, there's no council action required for the report. Finance Committee usually just reports on their review of the audit. There's no recommendation that comes out.
Thanks, Athena. That's what I was looking for. That so we're acknowledging. So at some point when we write a general report, we'll say we received it and it's on file.
Good.
and Sean,
it will be posted on the website as well.
Great. And then, Mandy, I just have one more. Is this the audit of the year that closes June 2025? Are we going to be seeing that before December? Just on are we going to be seeing that also, or what's the timing on that one?
No, so that will probably be, if we start to catch up, I imagine a spring, early summer. Some of it's us, we have to, finish some things and get it submitted to CBIZ in order for them to do their audit. CBIZ also has a busy schedule as well, so they need to have time to actually dedicate the staff to it. So sort of a combination, but right now we're still in the phase, I believe, of getting CBIZ all the information that we need to. So I wouldn't expect, I think we want to slowly get this back into an earlier cycle. So, our goal, I think, would be before summer, try to have the FY25 come back to the committee if possible.
Okay. Mandy.
Yeah, our audit review was done, I don't know, sometime in like April or May of 2024 for the 2023 season. So it's typically a spring review. So I think that's what we're aiming for again. When we do the report, Kathy, all I wanted to say was, I think it's important to highlight that the auditors, that it was basically as he said, a clean audit. That's all I'd say.
No, I think that, and, especially the checklist at the end, it was clean all the way through with the level of risk was low, and when explored, those weren't big concerns. I do think a note about OPEB and the trade-off with pensions is also worth, in a long-term view as it affects our flows over the years. So I thought those two were notable to note, and that people can see that now that this note is being added to the report. I think it's a good note to add that it's being acknowledged in the report as well, if we look out multiple years. Anything else on this report? And I have to say, Scott, I just thought you did a thorough and succinct review, and I really appreciate that.
Thank you.
Both the report, but also the way of presenting it. We all got it last week, so we did have a chance to look at it, but thank you very much.
Yeah, Scott, good job and good luck with your shoulder.
Thank you.
And I'm going to pronounce her name more, Nadzea. Is that how would I say her name? Thank you, because I understand you're a team that has brought this report to us. So I want to thank you both very much. Yeah. And I think if we have no other questions, you can go back to the rest of your lives.
Thank you very much for your time this afternoon.
Thank
Have
you.
a great rest of the meeting.
Take care.
Thank you. Have a good day.
Oh, and we got him out in plenty of time. So now, the second item on the agenda was this update on school debt.
We were going to do public comment. Sorry for
So I
interrupting.
want to just say, should we do public comments at this point? Yes. So if everyone is okay with that, I will open us for public comments right now. And anyone who has a public comment, please raise their hand. Okay, here we go. Okay, Deb, I believe I brought you in.
Hi, Kathy. I sent an email, but I thought I would just say it here because it's on my mind that it'd be great to have this in the packet. There's no agenda, there's no draft report in the packet, and hearing that you got it last week would have been helpful to have ahead of this meeting for the rest of us.
Thank you. Thank you, Deb.
Thanks.
Any other comments? So seeing none, one of the other items on the agenda is minutes, and I think as people noticed, there are no minutes in the packet. I think there was just a miscommunication on getting the agenda in and getting this posted. We will get better at it now that we're back to full finance staff. But there are no minutes to review either, just so people know. There are no new minutes to review in our packet, and I haven't seen any. So we still have a lot of minutes to post that have been reviewed, but those haven't been posted yet. So I will do that aside from this time. So Sean, I'm turning it back over to you for the two other items we posted on the agenda, although it's listed in the wording, it's just not in the packet. Yeah.
Yeah, so almost back to full finance staff, not quite back to full finance staff. We still have a comptroller position to fill that we're hopeful to fill soon. So I was going to give an update on the Fort River project and the library project. I apologize, it's going to be a sort of a high level update for now, with the goal of bringing back more detailed information at a future meeting. I am meeting with our financial advisors, Unibank, tomorrow, and that's where we'll get more into the weeds and get caught up on exactly kind of where we're at with all the borrowing. But I did have a preliminary discussion with them. So I'm going to give you some background, and if you've already know all this, or if you have this background, you can just, push me along. But when we do these big capital projects, we finance them through a combination of bond anticipation notes, which are sort of our short-term borrowing instruments. We do that for a period of time until we determine that it's time to do a permanent long-term bond, and then we'll go out and we'll issue that bond. The timing of when we convert from a ban to a bond can be influenced by a couple different things. One could be interest rates. Bans are short-term interest rates, bonds are long-term interest rates. And as you probably have read about a lot in the last couple of years and looking forward, the future of what interest rates are going to do are very kind of mixed. So like when the Fed discusses lowering their rate, that really impacts the ban rate, the short-term rate. So if they're talking about doing a rate reduction, that might help save us some short-term interest cost. The longer-term rates on bonds, which is really where most of the interest is paid, is really more influenced by like the expectations around the economy moving forward. So, so when you hear Fed reducing rates, don't necessarily think that might impact our bond rates. It could impact our ban rates when we go out. So that's one thing we look at is like, the timing of rate reductions and what might, maximize value for the city, what might reduce that interest cost. That's sort of our overall goal, is to minimize interest costs for these projects to the extent we can. But there's always risk associated with it, because you might think rates are going down and you hold out and then rates go up, right? And we've seen that in the past where rates have really bounced around. So, so with the Fort River project, we have a couple bonds. We have it, and I might be off a little bit here, but we have about a $12 million bond, and we have a $14 million bond, give or take. So those are permanent borrowings for that project. And then we also, as of May 31st of 2025, we also took out a $13.6 million ban. So all said and all combined between all those sources, we have about 39.6 million in debt for that project. The good news is we're not going to really need to borrow much more for that project. That's sort of enough to get us through with the MSBA reimbursements coming in, with the free cash that was appropriated, with possible tax credits coming back to us at the end of the project. We shouldn't need to go out to borrow for a while for that project. We might have to roll over that 13.6. That's a ban. At some point, we'll roll that over annually because that's it expires each year. But the next time we might have to go out for a permanent borrowing would be near the end of the project. So that's good news. And the reason I say that's good news is that allows us to get a more accurate projection of what the debt service will look like once it's in a bond. It sort of sets the interest rate, it sets the debt payments. And so it allows us to get a more accurate projection of what that debt exclusion payment will look like. Again, there's still some variability because we do have a ban and the timing of MSBA payments and things like that. But because we have those two bonds in place, and that's for a significant portion of the project, those payments are locked in and we started making payments. So one of the questions was, when will we see the debt exclusion hit the tax? When will people feel that on their tax bills? And based on what I've looked at, you already have a little bit. So there was a small amount of debt exclusion that hit in FY25, a bigger portion. So it was about 700,000, a little less than 700,000 in FY25. And that's projected to go up to about 2.1 million in FY26. And it will ramp up a little bit each year until FY29. And then it'll flatten out. It'll drop a little bit and then flatten out once the project's complete for the remainder of the debt service. So the good news, and I'm sure this was done intentionally, that sort of lines up with what we told people in terms of how the debt would escalate when sort of the peak of the debt exclusion would hit. And again, very preliminary analysis, based on the additional MSBA reimbursement that we've received, costs being favorable, it does look like that debt exclusion is going to be lower than what was originally forecasted in terms of the impact on tax bills. So that's good news. I'll get more detail to you exactly what that looks like again once I've had time to dig in. But looking at how much we're borrowing, what those debt payments look like, it's lower than what we were projecting initially because of those favorable developments. So that's sort of what I have on the Fort River project right now. Any questions on that project?
What's the maturity on the 12 and $14 million bonds we have?
Hold on, let me look right now.
If you don't have it offhand, don't worry about it.
Yeah, no.
Don't worry about it.
It looks like they go out. It looks like they're 30 years.
30 years. Okay,
So
cool.
they're yeah. When I'm looking at again, I'll get you the exact on each of these and how long they go out and what their each specific debt payment is. But it looks like they're going out to the 2050s. So that would put them at 30 years.
Good enough. Thank you.
And I think this report we just had, Joe, on the audit had one of them with that 30 years. I just was looking at, picked up one of them for the.
Yeah, that's pretty typical. Yep. Any other, Kathy?
Yeah, I have just a question in terms of what the taxpayers are going to see. Are we, when your tax bills, we're on the estimated first half, then we'll get the final second half of FY26. Will there be a line in the bill that explains to people that X amount is the debt exclusion?
So my understanding there isn't currently. We're going to look and see if that's possible. I don't know if it is within our accounting system. I'm going to talk to some other towns too that have had debt exclusions to see what they have. But my understanding is this most recent year that wasn't the case. So I know that would be nice for people to see what portion of their tax bill is related, not nice, but it would be informational and important for people to see what portion of their tax bill is related to the debt exclusion. So I'm going to look into that and see if that's something we can do, and I can report back to the committee if it's doable.
And if it can't be put in the regular bill, if it can be put in a cover note or something, on So then I had a separate question, and this is just for people who aren't staring at the costs as they come in and where we are in the building. We're right now coming in under the budget that we had agreed to with MSBA. We don't know until it closes out where we will be, but we won't be borrowing for that. I'll ask it as a question, Sean. There's a contingency that we may not spend most of it, and we're kind of reserving it, but we won't be borrowing for that until we close it out. And how do we schedule that? And we're not going to actually spend the full 98 million of the building costs because
Yeah.
Yeah.
So they'll be conservative. We get cash flow projections from the OPM, and that's sort of how we model out when we need to borrow and what we've borrowed so far. So I haven't gotten to that level to look at the most recent cash flow. Did that assume spending that contingency, or did it assume not spending that contingency, or some portion of that contingency? I think generally they're going to lean to the conservative side. And then if we don't have to spend it and we can, pay back some of it early, then we would. But that's something I'll be digging into.
So Paul, I know there was MSBA asked us at one point, what are we going to do with it? And we're going to say, we said, we'll hold it, but we're, as a contingency. It was a similar question, it's a savings off the original estimate, but it's not like money.
Right.
It means we don't have to borrow that money. So that's a separate good news. And just so everyone knows, the estimator that was put up when the town voted on it was before MSBA gave us another $10 million toward the school. So we know that we were on the high end of the side of an estimate of what this was going to cost rather than low, which is good. The news will be better than we originally said, but that hasn't been adjusted for all sorts of good reasons, on the put your house in and see what your bill will be. So thank you.
Do you want me to transition to the library project?
Yep.
Okay. So the library project, we currently have a ban for 2.8 million. So we have a bond anticipation note for 2.8 million. We've received MBLC grants totaling about 8.3 million. And we have about 4.1, 4.2 in contributions from the library. So based on those funding sources, and the cash flow that we received from the OPM for that project, it looks like we're going to have to go out for another borrowing in December of 2025 and borrow, because we're at that point, we will have exhausted all the MBLC funds, we will have exhausted all the library contributions, and we'll need to get the ban in order to continue to be able to pay the bills. So we would go out for a ban in December. It's likely that ban will be a very short-term ban because that original 2.8 that I said we already have borrowed, that expires in March. So we borrowed that last March, it expires this March. So we'll probably go out in December, borrow what we need, have it expire in March so that we can go out for just one new ban that kind of combines the two going forward. And that'll be easier to track. At that point, we're also going to have to decide whether we bond for some of the project in March or if we continue to do a ban. Some of the things we're talking about tomorrow is what would be the benefits of bonding for the town share at that point, and starting to pay back on the town share, and then doing a ban for the project costs above and beyond that. So that's sort of the timing we're looking at. We have an estimated another MBLC payment in June of 2026, and then another MBLC payment at the very end. And then the library contributions for conservatism's sake, we're assuming them just come in at the end. And then if they come in earlier, it'll improve our cash flow, and we won't have to borrow as much. So that's sort of where we're at with that project. And that cash flow was updated recently, so this should be pretty good timeline for what we're looking at.
Mandy?
Thank you, Sean. What's a couple of questions. The first one is the ban that you're looking at going out in December. How much is that going to be for, or approximately?
So I haven't kind of interrogated the financial advisor on this yet, but about 9 million in December. Yep.
Okay. And the next question is, there is currently part of the funding is CPA for $1 million that I think was intended to be borrowed. How does that work within these bands and then the final town share when you bond it out. Will that be included in the bond
So
for the
that's,
town
I
share
believe
or
that's in
something
that,
else?
I believe that's in that 2.8 that I already gave you, looking at the way he's got this organized. So that portion, I believe, has already been borrowed as part of that 2.8. But if not, it would definitely be in the new money that we're borrowing in December.
And so it might be in the one big bond when you go to bond term.
Yeah,
And then
it
you'll
probably will be, but we'll have to piece out funding, where the expense is to pay the principal,
Yeah.
interest and
Okay.
principal payments on it. Yep.
Thanks.
So, okay, I guess I'll raise my hand and call on myself. There we go. Normally, the beginning discussion of the capital budget and the capital plan would start in February-ish. And the library has a line in terms of debt service going through it. And that was updated, Sean, in just as we closed out the capital plan in terms of it went lower than it had originally been because the building hadn't started to be built yet. Will you have a revised set of estimates going out for the 5-year plan that incorporate what you have just told us?
Yeah, when you say the line, are you
What I'm
referring?
getting at is, how much will that be
Yeah.
costing in terms of our own capital plan and our resources?
Yeah, so unlike the Fort River project where the financial advisor actually modeled out the debt service, he hasn't modeled out the debt service yet for the library project based on that cash flow I just described. I think he's looking for some direction from us first, and then he will. But yes, whatever our most current cash flow analysis is and related debt projection based on that, that would go into that capital plan when we put that together. So there may be a couple versions between then and now, just based on us working together. But yeah, we'll definitely update that number in the capital plan to be whatever the most current is.
Mandy?
Thank you. 2 other questions. You said the next borrowing in December is going to be for about $9 million. How long till the next borrowing after that, or stuff might it's not a last thing, but yeah, how long is that intended to sort of
Right.
last?
So again,
I understand it would be a short-term issue, but how long would it pay bills?
So if we were to borrow the 9 million in December, and then again, it would be like a 3-month ban, which we would issue another borrowing in March of 2026, which would incorporate that 9 million plus what we already had as a ban, the 2.8, plus some new money, looking at the cash flow of the project going forward. Because the 9 million is sort of equal to about 3 months of bills being paid based on the cash flow that we have. So the March borrowing is projected to be about 18 million. So it would be the 9 million plus 18 million in new borrowing plus the 2.8. So in total, it's going to be about 30 million that we would have on the books in March. And then that would carry us through the end of the project. At the end of the project, we would pay off that 30 million with the MBLC money as we receive it, and with the library contributions, leaving us with just the portion that would be the town share.
Okay, thank you. And following question, when are the MBLC payments slated to come in, and how many more do we have?
So
it looks like we've gotten about half of what they're going to give us.
Yeah, we've gotten 3 of 5. So we have one, again, I have to dig into this a little bit, but it's projected for June of 2026, and then one for March of 2027. So it would be after closeout and things, all that.
And those are, did you say 2.6 each time?
They're each about 2.77 million. Yeah.
And Sean, can you speak to the differential in sort of the interest rates that, for the bands? Is there kind of a general interest rate that we're seeing when we do one of these short-term notes? I mean, is it like in a you don't have to be specific, but general idea of interest cost thinking?
I haven't actually gotten that far yet. So
Okay, no worries.
I can send the group. We get so one nice thing that we get by being a customer of Unibank is we get monthly offering reports. So we can see every community that went out to borrow and what the rates were for short-term and long-term. So I haven't looked at it recently, so I don't want to throw out a percentage because I could be off. So, but I can email the committee after with what our current bands are at, just so you have a general sense of where we're at currently. Yep.
I think the good news is compared to 2 years ago, it's on the downside rather than the upside.
Yeah, it's trending down, I think, which is good.
You know, a few years ago, we were thinking 4 might be good, you know, or 5, and now, you know, so, but yeah, but, and the spread, Joe, well, you know this too, the spread was bigger too. You know?
Definitely. Yeah, absolutely. Yep. But yeah, obviously, after 22, those short rates definitely popped out, but they are coming down. So that's good. All right. Thank you.
Other questions on Fort River or the library project?
No, thank you for, I know it was, Sean had been back by 1 day, I think, when I asked him to see if he could update these numbers. And I like he said, sure, you want them in a week? But thank you very much.
You're welcome.
For doing that. I don't think there's, you know, there aren't any minutes to review, and I will try to figure out where the minutes are. The other is just, we've been talking about the updating of the guidelines, and I think everyone knows on the council, but I wanted to make sure both Joe and Tom know Monday night we'll get the indicators report, which will be the projections of revenues and expenditures out multiple years with an explanation of where we are. And that's scheduled for to start at 6 o'clock. So it's an early start for the council meeting. So that'll be not just the beginning of the council meeting, but it's the first item on the council meeting. And you are invited. If you're there, we will call on you to be full participants at that meeting. And it's a time where we can ask questions. That feeds in then to what we already started as a recommendation for guidelines. And the guidelines report from last year has been posted. We started talking about that over the summer. And Joe, I'm not sure you were there then, so I'll make sure you get a copy of that. And we started focusing on which areas are the key areas. So some of them are what percent, and is it equal or not for operating budgets? Can we recommend what percent for capital? And as Mandy said, we made some recommendations last year about budgeting and revenue forecasting based on what we were seeing. And we also made some comments on the use of free cash once it's certified, where one might put it. So I think we don't have another meeting until November 12th. That's a Wednesday in the schedule. So that's where we'll focus on the guidelines based on what we heard on the indicators. And I think maybe we can write a shorter report and really focus on those key areas. We've been writing longer reports to talk about goals more generally, but trying to expedite the report because there'll be a lot of interest in the public as well as the council on discussing this. So we have that meeting, and we have a second meeting the week after that in November, before December is on our schedule. And Paul, I see your hand is up. So just
the 12th and the 19th, what are the times of those meetings, or just
the 12th is a Wednesday,
right?
Because we were
Right.
hitting these holidays. The 12th,
But what time?
The 12th is 2 o'clock.
Okay.
And the 18th right now is penciled in as 10 in the morning because we shifted the starting time so the worker could make it. So unless I hear differently, those are still in the agenda.
Good.
So those are the times for those. Mandy.
Thank you.
And Kathy, there's oh, sorry, did someone else? Oh,
No,
man.
go
No,
it's
go.
okay. You can go, Joe.
Okay. I apologize. Next Monday, there is the council meeting next Monday.
The
Okay.
council's meeting on Monday night. It's a Zoom meeting, and I'll
Okay.
make sure you get a invite to that. Athena can
I may
see-
not be able to make it. I literally am going to be on an airplane to California for business on Monday night, next Monday. So I will try to zoom in if I can, but if I'm
Okay,
here.
and the thing is, it's a Zoom meeting, so you
Okay,
can zoom
good. Yeah,
in
so
from
I'll try to do it
anywhere.
on the plane. That'd be
But
great.
the other thing we can do is give you a link right after the meeting. You know, it's a document that gets presented, so we can put it in the Finance Committee packet, but I'll make sure you get it as
I
well.
appreciate that. Thank you so much.
Mandy,
Yeah, I just wanted to say I wholeheartedly support trying to get the budget guidelines down to absolutely what is necessary to be in them and as short as possible. I think it makes it a more ease of use and clear document to do that. And then I just had a question for Sean. I've been getting a lot of questions as to when sort of budget closeout will be done. And I know you just started, but and we've been really short-staffed, but can you give us an estimate of when we might see the year ends, the closeout, the certified free cash, and then for Paul, I guess, any potential financial orders that come out of that?
Yeah, so in terms of priorities, our goal is to get the indicators report and sort of the projections done for Monday, and then really turning our focus to closing out FY25. So getting our Schedule A's, all the reports we have to submit to the state done, which allows us to certify our free cash, make sure we're ready to set the tax rate. And along with that, we'll be doing like the final budget report. So my take is that final budget report has not been presented to the Finance Committee yet for FY25. Okay, so as part of that closeout, we'll do that as well. Yeah, so I would say hoping to have all that done during the month of November. Or in some cases have to have that done during the month of November.
yeah, so
Am I correct that the council has to set the tax rates by the end of December?
Yes, yep. And typically we don't want to wait that long either. We typically will try to do it earlier. I think the classification hearing is scheduled for
The 17th.
mid-November, the
Yeah.
17th, yep.
So right now, Sean, we have, as I just said, a meeting on the 12th and a meeting on the 18th. I don't know whether you'll be ready on the 18th. The next one would be December for finance. So, I mean, you don't have to commit right now, but I think that's what Mandy was saying, you know, when we might be seeing that. So if we have to add a meeting, we will.
Okay.
Yeah. You know, or if we have to post a longer meeting, we will, you know,
Yeah.
in somewhere in adjusting to the fact that you can only do so much. And so-
Yeah, no, again, it's a high priority. Again, it's the highest priority for us after we get this stuff done for Monday night. And then, and we're hopefully be hiring a comptroller soon. That'll accelerate how quickly we can get a lot of it done as well. Knock on wood. But like I said, it has to get done. So it's going to get done one way or the other in the next month or so.
Yeah, so once we submit our stuff, then the DOR has to take time. They've got 351 cities and towns they have to process as well. And usually they're all coming in at November, December.
So I have just, as I think everyone knows, as chair of finance, I've been working with a group. We had talked about this at the council level. A group from the other 4 towns that have finance people in it in terms of regional and getting ready for the 4 towns meeting. And there is a data report that was generated by the data people in each of the 4 towns, meaning the finance people. And it'll be in the council packet for Monday night, but the other towns have not seen it. You know, the select board members have not seen it yet. So there's a discussion of that tonight after this meeting. So I will send you the draft, just everyone on the finance committee, because we won't have an opportunity to weigh in on this before the 4 towns meeting happens, but there'll be an opportunity for all the counselors to weigh in on it on Monday night. So I'll just send everyone a copy of this. It's literally charts, you know, what we're all facing in terms of revenues and where we've been over the last few years, tax rates that we pay, drawing some from the Mars report. So having mentioned it, I think I can post it in today's packet, but I will also send it to everyone. So to the extent the public wants to see it, they can see it in today's packet. But I don't want to present it because something might change from it. So, and it's not on the agenda. So this is more an announcement that you're going to see it on Monday night. And if I send it to everyone and post it, if you have any comments and you send them back to me, it would be great just so that I can have that to think about for Monday night and for the meeting after that. So that meeting, my understanding, and Joe and Tom, you are invited to come to that Four Towns meeting. This is on the regional budget, is there will be an opportunity for the towns to talk, not just for the regional. It's going to be an agenda that will be a back and forth, but I haven't seen an agenda yet either, so I just know we've been invited. So that's just an announcement on that.
Thank you.
And anything else? Because I think, we're the rest of the year will be on this focus on the budget, the focus, as Mandy said, on certified free cash and what, if anything, the town is proposing for the uses of that free cash, where some of it could actually be put into the capital budget, the coming up next year's capital budget plan allocated. So we will have time for that between now and the end of December. It'll be a fun time for all of us, is the way I look at it. So beyond that, I will make sure this audit report is posted in today's packet and the agenda is posted. That was just, I thought it had been, and when I checked this morning, it wasn't. And I will try to find out what I can do about getting the minutes posted. Bob, some of the ones you reviewed have not been posted yet. I reviewed several months worth. They haven't been posted yet. So I'll just try to catch up so that when people want to look at minutes, they can find them if they want to read minutes. And I don't have anything else. So I think I'll make a motion to adjourn unless anyone has anything else they would like to bring up. I make a motion to adjourn then.
Second?
Bob seconds. Kathy's a yes. Bob?
Yes.
Counselor Haneke?
Aye.
Andy?
Aye.
Joe?
Aye.
Tom?
I support.
It's unanimous, and a big thanks to Sean for coming back to
Thank
us,
you.
for bringing us a finished audit. Thank you very much.
Finance
We
committee has
are-
always been my favorite. So smart you guys to know that.
We are adjourned.
Thank you.
Bye, everyone.
Aye.